Hello and welcome to this week's session. So today we've got with us Jason Howard, and Jason's the director of a large financial services business here in the UK. But today we're talking to him as an investor in his own right. Hi Jason.
Hey Joe.
So tell us a bit about your current investments.
Well, I think, Joe, we should start at the beginning and ask, why does anybody invest? Because an investment, first of all, is something we all do and has a little bit of pain.
Okay.
But the
Does it have to have pain?
Well, I think it has to have commitment. So you have to decide to give up a moment in time to sacrifice for a greater time in the future.
Okay.
So I invest, and I started from a very young age because I want financial freedom. And financial freedom, even though we're living in a time of COVID now and freedom is a very interesting thing, it just means that I can do what I want with the time I have left without thinking about sacrificing my time to go to work.
Okay.
I go to work because I choose to go to work because my investments now pay. So my investments are my employment.
Okay. And that took you how long to create?
Well, I think you start somewhere. So at the age of 18, I had my first child at 17. And one of the things I thought straight away is I haven't got enough money to invest. So I need the bank to help me. So I took a personal loan of £3,000 from the bank, literally walked around the block and paid it back to them straight away.
Okay.
And the reason why I did that was I believe that if you're credit worthy and you have the ability to get credit, you have the ability to invest, which we'll talk about later.
Okay.
But I started investing from a very young age. And
so you were kind of what, 18 at that? 18, 19?
Yeah, I would. Listen, we lived in a council flat, my wife and I, and we had very little spare money. But we would have a guy from the old home service. So a lot of the people on the video listening today may not even know what we mean, but there'll be a man knocking on the door to collect money.
Okay.
And we didn't want to pay him the money.
Okay.
And we would hide behind the sofa, but he knew we were there.
Okay.
And we would pay the money.
And this was an investment from a family perspective.
Yeah, it would be a very small investment because, Joe, if you've got no money, you can't invest big.
Yeah.
So you have to put something away. That money enabled us, when our daughter hit a certain age in life, it helped us get her started in life. Okay. But we had to sacrifice out of our very humble money at that time to put money away for the future. And I think one of the things people don't do today is sacrifice for tomorrow, and they live for today. If you had to ask me how am I investing today, so I've been quite fortunate in that time period to understand how the investment world works and to put money aside.
But you're managing clients' money as well, aren't you? Not in relation to this conversation, but how much client money do you manage?
More than £1 billion.
Okay.
So, but when you run clients' money, the only thing a client really cares about is a few things. The biggest thing is that they never run out of the stuff. So the biggest thing we spend time with the client is to help them understand what do they need the money for, what does their life cost them, and how do we ensure that they never run out of money. The second thing after that is to ensure that the people they love get the money if they don't have it. So what we're referring to there is making sure that where possible, the contribution to the government isn't as great and the contribution to the family is greater.
Okay.
It is as simple as that with everybody. Where you put the money after that, well, that's just fun, isn't it? That's just fun. I mean, at the moment, I've never known a time where there is so much hype around money, and you could read any piece of press, you could Google anything, and you might have found the latest get-rich scheme. And that's when you got to worry.
Yeah. So what are you seeing at the moment that looks like that?
Well, I'm not saying Bitcoin is a get-rich scheme. It's just parabolic in how it behaves. And it means that, people literally, we put some clients into Bitcoin who understand what goes on, but literally you can make 10 times return on your money in a year. That's not normal, Joe.
No.
When inflation is 2%, when a bank interest rate is less than 1%, 10 times return would take you literally, just quickly work out the maths on that. So 1 times return would take you 100 years. So it's 1,000 years. I haven't got long enough on the planet on a bank interest rate to get 1,000 years of return.
Yeah.
So you're seeing a lot of things. You're seeing a lot of speculation in tech. You're seeing a lot of speculation in investments. You're seeing the trend in the US on Robinhood investments, where you've got the US government giving people money to invest, And the crazy thing at the moment is, they are putting them in the highest risk investments.
So just obviously the Robinhood part, just to tell us a bit about that as
So
a terminology.
Robinhood is a platform in the US, like you have Hargreaves Lansdown in the UK, but at the moment the US government is literally giving people money. They are then putting it onto investment platforms, and they are buying high risk stocks to try and make money with that money.
And they're doing this through quantitative easing.
Well, the money coming from the US is something called quantitative easing, but it's a change in fiscal policy whereby it's called universal credit effectively, whereby we're going to get very deep now, Joe, but effectively the question I get asked a lot by people is how we're going to pay the bill for the crisis. And this does relate later on to when we talk about property, but the next stage is how does the US government and the UK government ever pay back their debt? Well, the simple answer is they don't. What they do is they make sure they keep the interest rate low and give the perception of paying back the interest. It is the biggest interest-only mortgage you're ever going to see in history. If it ever gets questioned, and it will one day, you might go through a reset, but at the moment, they just need to keep the game going. We're getting deep.
Yeah.
We're getting very deep.
So just on that point though, and then we'll kind of get back to kind of more your personal, but do you think there will be a debt amnesty or a sort of debt jubilee as they call it in the UK?
I think what everybody needs to understand with debt, if you lent me some money and I couldn't pay you back, what do? So at some point, so there's three ways you get out of debt. You either grow your way out of debt, and I don't want to be negative now, but in the history of the economy of the Western world, nobody's ever grown their way out of debt. You either inflate your way out of debt, and that's what you see in a property market. So inflating your way out of debt is the prices of goods and assets increase so much that the debt looks small. Simple example there, if you bought a home 20 years ago for 100,000 with 50,000 mortgage, that house today could be worth 500,000, you still only got a 50,000 mortgage. So if you can inflate away the debt, it's not so important. And the third option is if we've got Argentinians on the call today, I'm not being rude to Argentina, but it's what Argentina does on a regular basis. They just decide not to pay back their debt. Now, defaulting on your debt and a debt jubilee, what is the difference? So do I think we'll have a default on debt? Absolutely not. Because as soon as there's a default on debt, the whole system crashes in because no one trusts the system.
So a jubilee is possibly the way out of it?
Possibly, but I think the bigger way out of it is the inflation of asset prices. So
or a combination?
Combination, but the safest way to get out of this problem is to get people to invest and make sure those asset prices become greater, which means then the M2 supply of money hopefully becomes greater, which means the debt becomes less. So never in your life have you had a time where you need to be an investor.
So just talk us through that on a kind of layman's basis, on the basis how can someone watching this capitalise on that view?
Well, one of the concepts I want everybody who's watching this today to really bear in mind is something called a store of wealth. A store of wealth means you don't get hurt by what we're talking about now. So the classic examples of a store of wealth are real assets. That could be anything from property to gold to real things. And I was only talking to somebody the other day, Joe, I know you like your suits. All right, and I know that if you had the chance and the shops were open again, you wouldn't mind walking down Savile Row. But if you'd have gone back to 1975 and you weren't even on this planet, but it was 1975 and you were...
was in 1975.
I know you were just, but I was trying to be nice. And you were walking down Savile Row and you had £100 in your pocket and you went in to see the tailor and the tailor got you the best cloth that you like for your suit. You could exchange that goods and services for £100 for a suit and everybody walks away. And that was in your right-hand pocket. And in your left-hand pocket, you could have an ounce of gold. And he could have also accepted the ounce of gold, which was worth about £100. Go forward in time to 2021, and Joe's been a really shrewd investor. He's left that £100 in his pocket. He's decided, I'm not going to risk that. I'm going to keep my £100 in my pocket. So he goes back in time, back to the future, crazy scientist, Michael J. Fox, and he walks into the suit shop, And he said, hello, Mr. Tavelrow, I want that same suit from 1975. And you go into your right-hand pocket and you pull out £100. And he said, no, sorry, Joe, it doesn't buy it anymore. But you go in your left-hand pocket, you pull out that same ounce of gold. But because it's a store of wealth, you can still buy the suit today, which would be £1,500. So what I'm trying to say here is people need to understand, start thinking now, if you've got any ability to have any spare cash, and I'm going to mention property, it is one of the ultimate stores of wealth. Through any long-term time period, it can't do anything but increase in value. Because long-term, definitely not short-term. Short-term is fool's gold. But the real gold and the real value and the real financial freedom is by taking a long-term view on property.
So you mentioned gold and property as those assets. Anything else?
Well, I mean, at the moment, I would argue, if I was drawing a quadrant for clients, there's four investment plays I think they should consider today. And those four plays are, if you're investing, you should look at how you think the world is going to change from COVID. So over the next 10 to 15 years, you're going to see the new technologies. I've never known it to move so quick. There's going to be the big battle of the electrification of cars. I know you're a car fan, Joe. Well, 10 years from now, we'll be standing on the side of a road, in Birmingham, and every now and then we go, look at that old combustion engine. Aren't they amazing? Yeah. They just won't exist in the UK. So
in 10 years?
Well, it depends if they can get the infrastructure. For me, it's all about the electrification of the world, moving from fossil to energy. But so one of the themes to think about is tomorrow's world.
Yeah.
So look to invest for tomorrow's world through stocks. The other thing to think about now, which completely contradicts with that though, is tomorrow's world will happen, but today's world had a little bit of a hiccup through COVID. And I think there's a recovery play in COVID. So I think a lot of the UK companies that were battered through COVID actually are very, very, very undervalued.
Airlines?
Well, you could look at an airline play. If you look at IAG, British Airways, IAG, the EasyJet, this could be a play. Rolls-Royce. By the way, folks, I'm not telling you to buy these companies. BP, Shell. So these are big cash flow generating businesses that their share price, was absolutely crucified through this crisis. So there could be opportunities there. So I think there's a COVID recovery play. Okay. There's a future industry play. I also think there's the inflation trade. So I've talked to you about inflation. So the store of wealth play, and that would be things that don't get hurt by inflation. So the biggest things that get hurt by inflation is cash and low yielding government bonds, government debt, biggest market in the world. So look at the things that will avoid the inflation. So that is real assets, precious metals, oil. So funny enough, I might contradict myself slightly, but have a balanced approach. And then the final.
So oil would be in there, even though.
Yeah, I think the reason why I think the oil price, I'm being controversial now, but I think the oil price will rise, not because about the demand increase, but the supply destruction. So when you have no money and no investment going into something, all of a sudden, the access to the product becomes less. So the supply curve drops down, which means that actually the supply destruction will put the price of oil up. And I wouldn't be surprised if you saw $100 barrel oil again. And it will be its last hurrah. Yeah. Remember, just before a star explodes, it's its brightest point. Yeah. So just because I'm saying to you that we're going to have the decarbonisation of the world, it doesn't mean that it has its last hurrah, because at the moment, we can't electrify the whole planet overnight. So the requirement of all of the needs of your clients will need electricity, will need energy, and carbon energy is still the only thing we really know, and we're trying to do that transition. So that last hurrah, I still think happens.
And then all that is very much like a lot of things about timing, isn't it? So, and obviously, subject to how experienced you are as an investor, when to get in, when to get out.
Most people wouldn't have a clue, and most people have a herd mentality. So most people will do the things that their friends tell them to do, and they aren't a contrarian play. And the things I mentioned there are quite contrarian. So you have to be brave. You have to have the spare capital to do this, and you have to take a view. The final quadrant I'd say, by the way, Joe, is I also think and I know I've worked with you on some of this, but I've never seen such good opportunity in quality lending with good covenants at good yields for clients. So I also think the banking system is broke. The banking system for developers isn't right at the moment. So I think if you can get good solid coupons of 7-8% with a good covenant, this is an interesting point. Because remember the rule of 72. This rule of, I mean, one thing that I'm terrible at written English, as you know. I'm terrible at emails, and don't anybody write me an email. I'm great on the phone.
You won't get a reply.
I won't get a reply. But what I am very good at is numbers, and the rule of 72 I never forgot. And it's the thought of how you double money. Sure. So quite simply, at 7.2% return a year, your money doubles every 10 years. And at 10% a year, it's every 7.2 years. The problem is, the reason why people don't double their money is they spend it too quick. They never give the powerful pound a chance to grow.
The compound effect.
Compound effect, it's the eighth wonder of the natural world. Mr. Einstein told us that.
Yeah. So bringing it to property then, probably more specifically, but appreciate that overview. So can you tell us a bit about what your residential property portfolio looks like, or general views on sort of property and where you'd be investing?
All right, so I've made more mistakes than probably anybody I know on property. And the biggest mistake I have made over the years is not keeping it incredibly simple. And it would be following the next big thing. And so I started buying property, Joe, in 1996, first family home. And then I was only telling somebody the other day, the leverage from that meant I bought a bigger family home, which meant that on my second family home, I was able to refinance that. And by the way, folks, listen to what I'm saying. I was able to refinance it to buy my first foreign property for my family. And then it was about in the 2000s, and this woman called Amanda Lamb, who was the Scottish Widows advert in a black cloak, was doing a program called A Place in the Sun. And I think we'd just come out of the start of a property boom from 96 to 2003-4 in the UK. And what happens in every cycle is everybody now thinks this property market is the same globally. Yeah. And you would see a program on TV all the time. So I've made the classic mistakes of going into frontier markets. I've bought property in Romania, Bulgaria, Turkey, Cape Verde.
So very different dynamics to the UK market. I promise
you, I've done my nuts on each one. I mean, the funniest story I can tell everybody, so you can see that I'm an expert who's an idiot, is I bought some lovely barns in southern Bulgaria. We did them up beautifully. And I'm not got to think about gypsies, but there was a Romany family of sorts in southern Bulgaria. Just watched us do it, and they moved in. I did it all right. I did the legal system right. I bought the property through the right ways. We took them to court. Did we have a chance of getting that property back? Absolutely not. I mean, I'm so happy for that family today, living in that renovated home. I mean, I loved it. I mean, I even put lovely glass tiles in the bathroom. They've got an ensuite bathroom with glass tiles. They were used to caravans. So I think the moral of the story is the finest property market globally is the UK. Second to that, I would say, is Commonwealth countries. So I have done well in places like Canada. But globally, the number one property market is the UK. And the number one reason for it is, A, I trust the legal system. And secondly, you've got an exit. Yeah. And your exit on property is everything. There's no point buying anything in life if you bought it and there's no one else you can sell it onto. Sure. It's the biggest mistake.
And that's one of our points about, on a personal basis, that, when you look at sort of student pods, car parking spaces, all these kind of high yielding.
But they're not high yielding, Joe. They just look high yielding on the surface.
Yeah, but fundamentally, there's no aftermarket, is there? So that you can't liquidate what you've sold, so you can never get a real return.
I mean, yeah. I mean, I've been there, and we've had the opportunity to advise them to clients. And my fundamental question is always, would I buy it myself? And if I wouldn't buy it myself, there's no way I'm exposing clients to it. So in the UK at the moment, fundamentally, I think family homes are fantastic. Family homes where yield works. I was only on a call to a tax advisor in Malta yesterday. I said, what's life like in Malta? He said, great, I've got a beautiful apartment. I said, okay. He said, yeah, if I bought it, it'd be 1.2 mil, but to rent it's $1,000 a month. So I'm thinking, I agree. I'd rent 1.2 million for $1,000 a month. I'd like to live in a millionaire's property for $1,000 a month. Yeah. But I wouldn't like to own it.
No.
Your yield is terrible.
Yeah.
And I don't think people realise the yield compression that happened in central London. So I do think there's huge opportunity in family homes, you know, in parts of the UK where people just aren't aware, and there's a sweet spot. So yeah, I'm buying family homes, and if I buy apartments, and I do buy apartments, as you know, Joe, they have to be, and I know that everyone goes on about COVID, but the city centres will be back. Right, they're going to be back. All right, and the city centres of major cities in the UK, you know, especially the ones where the price point still works, being Birmingham, Manchester, it still works, Leeds. As long as it's a prime location and I haven't got caught up in the hype of a market at the end of the cycle, I think apartments do work as well in city centres. The only thing, as you know, I've had conversations with you on, is you just need to be with a good developer who controls the service charging, because the service charging is an uncontrollable cost. It's part of the investment package.
And we touched on that alongside, you know, within this series, we've talked about mortgaging, you know, the best sort of rates we can get currently, type of LTVs that are available, which was a positive story at the moment, as you're referring to, obviously low interest rates. We've touched on how to find, you know, a good tenant and how to best organise your portfolio to make it efficient. As you say, one of the key points there is just ensuring that you've got your costs in check, because it's ultimately your net yield that's the important point.
It is, Joe, but I think go back to the rule of 72. So let me just try and do this on okay. If, Joe, I got you 23, 24% return a year on the rule of 72, how many years does that take for the money to double?
4.
Just over 3.
Okay.
No, it's a number of times into 72, so I know I caught you out there. 18 would have been 4, weren't fair. 24 would have been, okay, weren't a fair question. I like catching you out, right? So it's about just over 3 years. So if I could show clients a very simple way with maths of doubling their money every 3 years, I think it's a surefire way to make real long-term wealth.
Sure.
And the way you do that, Joe, is really simple, all right? All you need to do is have 3% property price inflation and 5% yield,
okay,
with 75% gearing, based on an interest rate of 4%.
Okay.
I'll just work that out. I mean, I've just said a really high interest rate of 4. We could argue that the 75% gearing isn't always easy. It's more like 70 at the moment, yeah. Right? Maybe 60. Yeah. But, okay. You and I would hope that over the long period of time, 3% property price inflation is achieved. It hasn't, never not done it in a 10-year period by a long stretch.
Sure. But particularly where we are now in the cycle.
Where we are in the cycle, and then the final part on there was the interest rate being at 4, and the yield being at 5. So the yield being at 5. Those, if you add those numbers up, all right, you get 24% return per annum on cash, not on asset, on cash. Yeah. So therefore, clients' cash can double every 3 years. Well, all of a sudden, that sounds like Bitcoin, without the Bitcoin risk. Without the understanding, is it real or not real? Yeah. Because the point I say to all clients is, I'm yet to find a solution, a virtual solution for property. I'm yet to find the technology solution to property, because I feel that one of the best medicines on the planet is sleep. And I need to put my head down on a pillow every night. I can't find the virtual pillow.
None of these other asset classes you can live in.
No, they're just replicating a function of life. Yeah, by the human function of life needs sleep. So it needs shelter. It's one of the basic needs. This is why it's such a wonderful investment. It's not complicated. It's very simple. And the leverage, though, I will touch on the leverage. And when I say leverage, I mean the lending. I say to everybody who listens to this, guard your credit rating. Your credit rating is now the most valuable thing you have. The ability to get credit and mortgages is your opportunity to make a lot of money. Unfortunately, people haven't guarded their credit, so they can't get the mortgages. But if you can get a mortgage, oh my word, is it an easy time to make money. Because let's think about this out loud. So Joe, you and I want to go into business. And I'm going to give you a proposition now. And you tell me if you like this proposition.
Okay.
All right, Joe. Joe, will you invest in my business? Maybe.
Tell me more about it.
All right. It's going to be a property business, Joe.
Okay. I like the sound of it.
Okay. And what I want from you is, if we can, do this sort of equally, you're going to put in 75% of the money. I'm going to put in 25% of the money.
Okay.
But I'm going to keep 100% of the business. I'm not giving you any of the business. I'm having all of the return.
Okay. Pretty much a no at this point, but carry
Right?
on.
Why wouldn't you do this? And in return, I'm going to give you 3 or 4% interest for your 75% of your stake. Do you like that one?
No.
That's what every bank is doing with every client who takes out a mortgage. And if you're a business person or entrepreneur, you're sitting there giggling to yourself thinking, I want a mortgage all the time. Yet so many times I see clients fearful of the mortgage.
Yeah.
And when we mentioned other assets earlier on, whether it be to buy BP, Shell, Bitcoin, gold, you can't borrow money from the bank to do that. But with property, you can borrow money and you keep all the return. This is why property is the secret it is. It's not about the asset class. The asset class will over time perform probably 1 or 2% below shares on just 100% entry.
Yeah.
But on a geared effect, it will destroy it.
Yeah. And still the only asset class that pays for itself, or 75% of itself, from its own income.
Well, the other thing is, the income becomes your payer, and it's huge. And if people read, Robert Kiyosaki is one of the most famous, narrators in this subject. Rich Dad, Poor Dad, Cash Flow Quadrant. His latest line that blew my mind when he said it, because he's always said that your home, your main resident, is not an asset; it's a liability. But he's now saying the mortgage is the asset, the property is the liability.
Okay.
All right. This is one of the biggest world property investors because he's lived his whole life in the US on releasing money and living off that money. For him, the mortgages are giving him his lifestyle. The properties are just the vehicle to get money out of through mortgages.
Sure.
He's never had to worry about money ever again.
Right.
Okay, sorry, what was the question?
I think you've covered it.
Okay.